We continue to see a good growth momentum in our various businesses. We expect actually all our businesses to grow well. Now, surely some businesses will grow faster than the others. And I think the businesses that we expect to grow faster will be the financial inclusion business, the retail lending business, essentially, and the digital acquisitions that we are making. On the corporate side, we will see steady growth happening. We are more confident on the mid-corporates and the SME space, where we will perhaps expect to see even faster growth. That was one high-risk area in the past. I think we fine-tuned our business model extremely well. And today we are confident that that segment, there is a lot of untapped credit demand sitting there. On the lower side, the corporate segment should grow at 20% plus. And on the higher side, some of our, if I may say, financial inclusion and retail businesses should grow at 35-40%. And if you take on balance, it will sort of average out to that 30-35%, annual growth.
You did see some signs of stress last quarter, also this quarter, as far as the MFI book is concerned.
Sure.
This was partly due to demonetization. Going forward, do you expect the pain to continue, or do you think it peaked last quarter?
So the pain has peaked, but the residual effects of that are continuing. For instance, this entire sort of stressed portfolio has to be provided for, and the entire provision cycle will be 2 years. Some of it we have taken in this year, and some will continue into the next year. But having said that, we've factored all of that in, and it's not going to further disturb our numbers, either our gross NPA numbers or our net NPA numbers or our profitability. So the new lending that we have done in this space, starting say January or February this year, 2017, almost 2,000 crores new lending, is operating at a 99% plus recovery rate. Okay, so the point being made is that, in a sense, it is back to business as usual in this space, and it is sort of picking up and lifting quite nicely.
To what extent have these been provided for?
So on the average, the first round of provisioning was around 25 to 30%, and then see now the net effect of that on our portfolio is not very high, because again we have indicated that overall it's a 2.25%, so it's not going to get worse than that. We have managed to contain it within that range in the first year, between the 2 to 4% range, and going forward in around the 2% range. And even despite that, we end up with a 3.5% plus ROA in this business, despite that. So the point I'm making is, and it's about 4,000 crores or less than that, on a 40,000 crore approximately potential balance sheet size. This is a high growth, high opportunity area for us now. And all the new lending that we're doing and growing at 40% should further mitigate the net impact of that.
You raised funds via QIP recently. Any more capital raising plans on board?
So one philosophy of the bank has been to always remain extremely well capitalized. And we actually have been raising money little ahead of time.